All right, let's talk about something that turns a simple idea into, well, big money. And that is, how much is a business actually worth? Now, it sounds super complex, right? But I promise you, you already know the basics. So let's dive in.
Okay, so picture this. A friend comes up to you and says, "Hey, I built this awesome lemonade shop. Want to buy it?" You might be interested for sure, but what's the very first question that pops into your head?
Yeah, exactly. Okay, but how much is it worth? And believe it or not, that one simple question is the absolute core of what we're talking about today. See, you've already taken the first step in valuing a business without even trying.
So, what are we really asking when we ask that? Well, at its heart, figuring out what a business is worth is all about one thing: finding its fair price.
The fancy term for this whole process is business valuation. But don't let that intimidate you. All it really means is taking the emotion out of it and finding a logical economic value for a company. And it doesn't matter if it's a tiny lemonade stand or a huge, massive corporation, the principle's the same. And here's the thing, you do this all the time, probably without even thinking about it, right? You wouldn't just buy a house without knowing its value. You'd check the price of a new phone before you hit buy. You'd definitely bargain for a secondhand bike. A business is no different. It just needs a price tag. But, that price tag isn't just pulled out of thin air. It really boils down to three key things: how much money it's making, how safe or stable that money is, and how fast it has the potential to grow. Just remember those three: earnings, safety, and growth. Everything else kind of builds on that.
All right, so how do we actually put a number on our lemonade shop? Well, let's open up the toolkit, shall we? There are basically three main ways to price it. And the very first, and you could argue the most important question you need to ask is this: how much money is this thing gonna make in the future? Because remember, you're not just buying what the business is today, you're buying what it can earn for you tomorrow and the day after that.
And that question leads us straight into our first method, the income method. It is, as you can probably guess, all about one thing: future profits. So let's break this down. Let's say the shop makes a nice steady profit of 1,20,000 rupees a year. Now, if you're the buyer, you might think, okay, I want to make my money back in, say, 3 years. It's that simple. You just take that annual profit, 1,20,000, multiply it by 3, and boom, you get a valuation of 3,60,000. It's a really powerful idea, right? The money it'll make in the future determines its value today. Okay, that's one number. But you wouldn't just rely on one number, would you? You'd want a second opinion. And a really smart way to get one is to just, look around and ask, what are similar businesses selling for?
And that brings us to our second tool, the market comparison method. Honestly, the name says it all. You're just comparing this business to other similar ones that have sold recently.
I mean, think about it. If another lemonade shop just down the road, one that's pretty much identical in size, profit, and location, just sold for 4 lakh, well, it's a pretty safe bet that your friend's shop is worth something in that ballpark, right? It's exactly like checking what other houses on your street sold for. Okay, so for our third method, we need to think about the worst-case scenario. Let's say the business just closes down tomorrow. It's not a going concern anymore. What's left? What can you actually sell?
This is where the asset method comes in. This approach completely forgets about future profits. It doesn't care about them. It just asks a very simple question. If we sold off all the physical stuff this business owns, how much money would we get? This basically gives you a rock-bottom minimum value. It's your floor price.
So for our lemonade stand, you just add it all up. The juicing machine might be worth 20,000, the cart and fridge, another 20,000, and the table and glasses may be 10,000. Add it up and you get a total asset value of 50,000 rupees. Now, this is super useful for a business that isn't making money, but honestly, it's not a great way to value a growing business because it completely ignores all of that future potential we talked about. Okay, so now we have 3 different methods, giving us 3 different numbers. So which one's right? Well, here's the secret that they don't always tell you in the textbooks. In the real world, nobody uses just one method. See, the trick is picking the right tool or combination of tools for the job. If you're looking at a healthy, growing business, you're probably going to blend the income and market methods. You want to see its future earnings and how it stacks up against others. For a startup that isn't even profitable yet, it's all about future potential and comparing it to similar startups. And for a business that's, dying, you go right back to the asset method. You just want to know what it's worth if you sell it off for parts. And this brings us to probably the most important takeaway here. Valuation isn't about finding one single magic number. It's about finding a reasonable range. So our income method gave us 3.6 lakh.
The market method gave us 4 lakh. The real, final price? It's almost always going to be a negotiation that lands somewhere in that range.
Okay, so let's zoom out for a second. Let's forget the formulas and the methods for a minute and just talk about the simple logic behind it all. What is it that truly makes one business more valuable than another?
Well, what's the secret sauce? A really valuable business earns a stable profit, it's got lots of room to grow, and it's not super risky. But here's the real game changer. The thing that can make its value just skyrocket. Can it run without the owner? If the answer is yes, that's huge. Why? Because then you're not just buying yourself a job, you're buying a system, a machine that makes money all by itself.
So look, if you only remember one thing from all of this, let it be this sentence. At the end of the day, all the fancy spreadsheets, all the different methods, they all boil down to this one simple, powerful idea. A business is worth how much money it can give you in the future.